Welcome back to the Pro Ticker Podcast, your Friday morning edition covering major financial magazine headlines. Everyone, create a long, detailed podcast episode with in-depth analysis, balanced opinions, dynamic conversation. Okay, so this week, we're seeing some really interesting market moves that go way beyond just the usual daily ups and downs. Tesla, for instance, is making headlines, with Bloomberg reporting their stock has plummeted about 40% from its high back in late 2024. Seems like there's a lot more to unpack here than just the talk of slowing EV sales.
You're right. There's definitely more to it. What's interesting is that Tesla's struggles could be an early warning sign for the broader market, especially for those high-growth tech companies that investors have been pouring money into. Bloomberg is suggesting that this momentum trade, where everyone jumps on the bandwagon of a rising stock, is losing its steam. Investors are starting to get a bit more cautious, and that can have ripple effects.
Could you explain what this momentum trade is for our listeners who might not be familiar with the term?
Of course. A momentum trade is essentially when investors buy into assets that are already going up in price, hoping to ride that wave of continued gains. It's a bit like a self-fulfilling prophecy. The more people buy, the higher the price goes, attracting even more buyers. But the risk is that if sentiment changes, even slightly, that upward momentum can reverse very quickly, leading to a sharp sell-off. And that's what we might be witnessing now.
That makes sense. So let's go back to Tesla. Bloomberg is reporting a whole bunch of bad news for them. European sales are down by almost half in January. Q4 deliveries were weaker than expected, and they've actually seen their first annual sales drop in over a decade. Add to that a profit miss, a lowered outlook for 2025. It's a lot to digest.
It really is. Tesla has always been a company that defied traditional valuation metrics. They've commanded a premium, what Bloomberg calls the Musk premium, based on the belief in Elon Musk's vision and the company's future potential, rather than just their current performance. But this string of bad news is making investors question whether that premium is still justified.
So what does this mean for the average investor who might have bought into Tesla at its peak? Are we seeing the beginning of the end for their dominance in the EV market?
Well, it's too early to say for certain. Remember, Tesla has bounced back from setbacks before. Bloomberg reminds us of the surge in their stock price after the election, when investors were betting on a close relationship between Musk and the new administration. Sentiment can change quickly, and that's something to keep in mind. However, this time does feel different. There are some fundamental concerns about their long-term strategy and their ability to maintain their market share as competition in the EV space heats up.
Okay, so it's not time to panic, but it is a wake-up call. But this brings up a bigger question. If Tesla's struggles are a symptom of a broader market shift, what does that mean for the rest of us? What should our listeners be paying attention to?
If we connect this to the bigger picture, it seems like we're entering a period of increased risk aversion. Safe haven assets are in, and risky bets are out. Bloomberg notes that consumer staples and healthcare are outperforming the tech sector this year. This is a classic sign of investors seeking stability and moving away from potentially volatile assets.
Those sectors that might have seemed boring before are suddenly looking a lot more attractive.
Exactly. It's all about reassessing your risk tolerance in light of changing market conditions. Those high-growth, high-risk tech companies that were everyone's darlings just a few months ago are facing a much tougher environment now, according to Bloomberg. Unprofitable tech stocks in those companies that have been heavily shorted are taking a real beating, with their prices falling back to pre-election levels.
And what about the Magnificent Seven, those giant tech companies? That seemed almost untouchable. Are they feeling the pressure too?
No. Even they aren't immune to this shift in sentiment. CNBC is reporting that they're down over 12% from their recent highs. This suggests that investors are becoming more discerning, focusing on fundamentals and valuations, rather than just chasing the hottest trends.
Oh, even the big players aren't safe. This really does seem like a widespread trend. Are individual investors, those who really fueled the momentum trade, also pulling back from the market?
According to Bloomberg, that's exactly what's happening. We're seeing a decline in retail investor participation, which is another sign that the appetite for risk is waning. It seems like we're seeing a shift from a fear of missing out mentality to a fear of losing everything sentiment.
It's an interesting way to put it. And it's not just limited to the U.S. market, right? I've been following the headlines, and CNBC is highlighting how Asian markets are also experiencing a downturn.
Yeah.
The Nikkei and Hang Seng are both down sharply. It feels like there's a global sense of anxiety among investors. What's driving this global unease?
A large part of it can be traced back to the escalating trade tensions we've been seeing. CNBC reports that President Trump has imposed additional tariffs on Chinese goods, on top of the tariffs on Mexico and Canada we discussed earlier. This uncertainty surrounding global trade is making investors nervous. It's pushing them towards safe havens, like the US dollar and gold, as Bloomberg explains.
That makes sense. But isn't a stronger U.S. dollar typically bad news for gold prices?
You're absolutely right. The Wall Street Journal points out that the dollar's strength is putting downward pressure on gold, which is usually considered a safe haven asset. However, there's a bit of a tug of war happening right now. The uncertainty generated by these trade disputes is still significant enough to support gold's value. Even with the dollar's rise, it'll be interesting to see how this dynamic plays out in the coming weeks.
It sounds like investors are trying to balance those two forces. So we've talked about the challenges and the anxieties. But are there any bright spots in all of this market turmoil? Are there any glimmers of hope for investors?
Absolutely. Even in times of uncertainty, there are always areas of growth and opportunity. For example, MarketWatch is reporting that NVIDIA, despite its recent stock dip, is still experiencing strong growth in the AI sector. That's positive news for the broader tech industry, suggesting that innovation and advancement in key areas continue, despite the overall market sentiment.
That's encouraging. It suggests that even with the tech sector facing headwinds, there are pockets of resilience and potential for growth. So it's not all doom and gloom for tech investors.
Definitely not. And it's not just NVIDIA. MarketWatch also points out that Dell is seeing a massive backlog in orders for their AI servers. This tells us that businesses are still investing in AI technology, recognizing its potential to drive growth and efficiency in the future. They're placing their bets on the transformative power of AI, even in a somewhat uncertain economic landscape.
So AI seems to be a bright spot amidst the current market uncertainty. Are there any other areas of strength outside of the tech sector that our listeners should be aware of?
There are a few. The Wall Street Journal recently reported that Germany's unemployment rate held steady in February, defying some expectations of a rise due to recent layoff announcements. This suggests that Europe's largest economy might be more resilient than initially thought, offering a glimmer of hope for the European region.
That's definitely a positive signal. It's a good reminder that even during periods of uncertainty, economic indicators can be mixed. It's important to look at the full picture and avoid making hasty judgments based on a few headlines.
Exactly. It's all about carefully analyzing the different factors at play and understanding how they might impact different sectors and regions. There are always opportunities for those who are willing to dig a little deeper and look beyond the surface.
So we've got a mixed bag of signals right now. We've got Tesla's troubles potentially signaling a broader shift in market sentiment. We've got trade tensions and a stronger dollar, creating global anxiety. But we've also got some bright spots. In areas like AI and the German economy, it seems like we're in for a bit of a bumpy ride in the markets. What's your advice for our listeners who are feeling a bit apprehensive about all of this?
It's understandable to feel apprehensive when the markets are volatile, but I think this is a time for cautious optimism. We're in a period of heightened uncertainty. That's undeniable. Trade tensions, slowing global growth, and this shift in investor sentiment, from risk-taking to risk-aversion, are all contributing to this volatility. However, I wouldn't advise anyone to panic and sell everything. Knee-jerk reactions are rarely the best approach when it comes to investing.
So what should investors focus on during these turbulent times? Should they just batten down the hatches and wait it out? Or are there still opportunities to be found?
While it's tempting to try to time the market perfectly and wait for the perfect moment to invest, that's rarely a winning strategy. Instead, focus on building a well-diversified portfolio that can weather different market conditions. Having a mix of assets, like stocks, bonds, and even some gold, can help cushion your portfolio against big swings in any one area.
That's the classic don't put all your eggs in one basket advice.
Exactly. And this is where those boring sectors, like consumer staples, can actually shine. People still need toothpaste and toilet paper. Regardless of what the stock market is doing, these companies tend to be more stable during economic downturns and can provide a sense of stability to your portfolio.
So a bit of boring can be a good thing for investors right now.
Absolutely. Balance is key. And don't forget about the importance of having some cash on hand. This gives you the flexibility to buy if the market dips further, or simply provides peace of mind, knowing you have a buffer if things get rough.
That makes a lot of sense. Having that cash cushion can take the pressure off and prevent you from making emotional decisions based on fear.
Exactly. It's about having a strategy you can stick with, rather than reacting emotionally to every headline or market fluctuation.
So bringing it back to this whole momentum trade unwinding, do you think this is a sign of a larger market correction on the horizon? or just a healthy pause after a period of strong growth?
That's the million-dollar question, isn't it? It's difficult to say for sure. There are experts who believe this is a temporary blip, a natural correction in a bull market that's been running for quite some time. Others see it as the beginning of a more significant downturn, a sign that the party is over and we're headed for a bear market.
So how should our listeners approach this uncertainty? What's the best course of action when the experts themselves seem divided on what the future holds?
I think the key is to be selective and focus on quality companies with strong fundamentals. Just because a stock price is down doesn't automatically make it a bargain. Do your research and look for companies with solid earnings, a good track record, and a competitive edge in their industry. These are the companies that are more likely to weather the storm and emerge stronger on the other side.
So it's more important than ever to do your homework and not just blindly follow the crowd.
Absolutely. Don't let fear or greed dictate your investment decisions. Take the time to understand the companies you're investing in, their financial health, their competitive landscape, and their long-term prospects. That's how you become a more informed and confident investor, no matter what the market is doing.
Speaking of risk tolerance, let's talk about one of the riskier assets out there. Cryptocurrencies. Bitcoin, for example, has taken quite a hit recently, down 25% from its all-time high, according to Bloomberg. What's driving this crypto sell-off? And should investors be worried?
Cryptocurrencies, by their very nature, are incredibly volatile, even more so than traditional stocks. Their value is heavily influenced by sentiment, speculation, and news flow, all of which can change rapidly and dramatically.
So is this just a case of the crypto bubble finally bursting?
It's hard to say definitively. There are experts who firmly believe that cryptocurrencies have the potential to revolutionize finance and become mainstream assets, while others remain skeptical, viewing them as speculative bubbles, prone to collapse. The truth is, it's still early days for cryptocurrencies. Their future is uncertain, and their path is likely to be bumpy.
So it's a high-risk, high-reward scenario, as with many emerging technologies.
Exactly. If you're considering investing in cryptocurrencies, it's absolutely crucial to understand the risks involved and only invest what you can comfortably afford to lose. This is not the place to put your life savings or funds you need for short-term goals. It's a speculative investment that requires a strong stomach for volatility.
That's sound advice. For any investment, really. Don't invest more than you can afford to lose, and make sure you understand the risks involved. But circling back to the overall market sentiment, it seems like fear and uncertainty are the dominant emotions right now. Is there anything on the horizon that could potentially shift this sentiment back towards optimism? Is there anything investors can look to for reassurance?
There are a few potential catalysts for a shift in sentiment. Firstly, a resolution to these ongoing trade tensions would be a major positive. If the U.S. can reach agreements with China, Canada, and Mexico, it could restore confidence in the global economy and give markets a much-needed boost.
So keeping a close eye on those trade negotiations is crucial.
Definitely. Any progress on that front could signal a turning point in the market's mood.
And what about the Federal Reserve? They've been raising interest rates to combat inflation. Could any changes in their policy potentially impact the market and investor sentiment?
The Fed's actions always have a significant impact on the market. If they signal a pause in rate hikes, or even a potential rate cut in the future, it could provide a boost to investor confidence. Lower interest rates typically make borrowing cheaper, which can stimulate economic activity and make stocks more attractive to investors.
So the Fed's next move is something investors should be watching closely.
Absolutely. Their policy decisions can have a ripple effect throughout the economy and the markets, influencing everything from borrowing costs for businesses and consumers to the valuations of stocks and bonds.
It seems like there are a lot of moving pieces right now, and it's hard to predict with any certainty what will happen next. It's a challenging time for investors to navigate.
That's the nature of the markets. There's always an element of uncertainty. But by staying informed, diversifying your portfolio, focusing on quality companies, and remembering your long-term investment goals, you can position yourself to navigate these turbulent waters and come out stronger on the other side.
You've given our listeners a lot to consider today. Is there anything else you'd like to add before we wrap up? Any final words of wisdom for those navigating these uncertain markets?
I think the most important thing to remember is that investing is a marathon, not a sprint. It's about making informed decisions, staying disciplined, and not letting short-term market fluctuations derail your long-term financial goals.
So much of what we've discussed today comes down to the idea of sentiment, how investors are feeling about the market. Seems to be driving a lot of these trends. But how can individual investors, like our listeners, actually track sentiment? Are there any indicators they can watch to get a sense of where the market might be heading?
That's a great question. There are a few things you can keep an eye on. First, pay attention to the CBOE Volatility Index, also known as the VIX. It's often referred to as the fear gauge because it measures the market's expectation of volatility over the next 30 days. When the VIX is high, it generally means investors are nervous and expect bigger price swings.
So if the VIX is spiking, it might be a sign to proceed with caution.
Exactly. Another thing to watch is investor surveys. There are several organizations that regularly poll investors about their outlook on the market. These surveys can give you a sense of whether sentiment is leaning towards optimism or pessimism.
So it's a combination of looking at hard data, like the VIX,
Yeah.
and also gauging the overall mood of the market through these surveys.
Precisely. And don't underestimate the power of reading. Pay attention to what analysts and economists are saying, but also form your own opinions based on your research and understanding of the market.
It all comes back to doing your homework and being an informed investor. We've covered a lot of ground today, from Tesla's troubles to the broader market shift towards risk aversion, the global impact of trade tensions, and even some bright spots in areas like AI and the German economy. It's a complex and ever-changing landscape out there. But before we let our listeners go, I have one final question that I'm sure is on everyone's mind. Is this a temporary blip or the start of a larger market correction? What do you think?
If I had a crystal ball, I'd be a very wealthy person. The truth is, no one knows for sure what the future holds. What I can say is that the factors we've discussed today, trade talks, the Fed's moves, investor sentiment, those areas of strength we highlighted, all of these will play a role in shaping the market's direction. The best advice I can give is to stay informed. Stay focused on your long-term goals and don't make any rash decisions based on fear or speculation.
That's excellent advice. We've given our listeners plenty to think about and keep an eye on. Remember, knowledge is power, especially when it comes to investing.
I completely agree. The more you understand the market and the forces driving it, the better equipped you'll be to make sound investment decisions.
Thank you so much for joining us today and sharing your expertise. It's been a fascinating and insightful conversation.
That's been my pleasure.
And to our listeners, thanks for tuning in. We'll see you on Monday morning with new headlines from major financial magazines.